Since the beginning of this year, I've been in the process of building out a database with in-depth details on alternative income asset classes like covered call ETFs, business development companies, and REITs, along with others, and all this will be available in just 1 week on Dividendology.com. But one of the databases that has been quite eye-opening is the covered call ETF database, which, by the way, I'm actually making this available for free, link in the description. Now, covered call ETFs have exploded in popularity in the last few years, and in fact, for the first time ever, there are now more US listed ETFs than US listed companies. There is a huge demand for ETFs right now. But unfortunately, many of these covered call ETFs seem to have a perpetually declining share price and net asset value, and this leads to smaller and smaller dividend payments as time goes on. In my ideal world, a good covered call ETF would be able to generate sustainable high monthly income with no net asset value decay over time and take part in some of the upside of the underlying holding. So in this video, we'll be looking at the 7 highest yielding covered call ETFs in the Dividendology database with no net asset value decline. Now to start, if we look at the Dividendology database, we can see there's currently around 65 different covered call ETFs, and I'll be adding more as time goes on. But here's where things get frightening. If we filter out all the ETFs that have seen net asset value decline, we can see all of a sudden our list gets reduced down drastically. All of a sudden we only have 27 covered call ETFs in this list that have grown net asset value since inception. So which 7 are the highest yielding? Well, coming in at number 1, we have Maxi from Simplify. This is a Simplify Bitcoin Strategy Plus Income ETF, and their yield for the trailing 12 months is 32.09%. It's pretty mind-blowing to achieve that yield without seeing net asset value decay. And if we look at the fund's fact sheet, we can see the goal is to seek capital gains and income by providing investors with exposure to Bitcoin while simultaneously generating income by selling short-dated put and or call spreads on a variety of equity and fixed income instruments, which may include indices, ETFs, or individual securities. Now, what's so interesting about Maxi is this was the first Bitcoin plus income exposure in an ETF. In fact, we can see it started trading back in September of 2022. It's a lot older than some of these newer crypto ETFs. And since inception, it's gone from about $12.52 per share, now all the way up to about $26.68 per share. Now, if we jump over to my dividend history spreadsheet, this is powered by Ticker Data. It's going to automatically import all the data for these ETFs. It's powered by Ticker Data, and it's going to automatically import all the dividend history for these ETFs. We'll come up here and plug in Maxi. And again, thanks to Ticker Data, the data will automatically load in. There's a link in the description. But here's what you'll notice about this ETF. There's a lot of fluctuations in the amount they pay out in dividends. And we have to remember there is a lot of variables at play when it comes to how much these covered call ETFs actually pay out in dividends. For example, how much volatility is there with the underlying holding? Is net asset value growing or declining? What type of different option strategies are the fund managers using? So definitely something to keep in mind. Now, when we look at this fund in the Dividendology database, there's a couple things we need to make note of. Yes, the expense ratio is high, sitting at about 0.97, but for the fund's performance, it's actually pretty reasonable. Now, assets under management is about 52 million, which actually seems like it's a bit on the low end for the success that the fund has seen. They use an out-of-the-money option strategy, which is typically better in bullish markets, which is exactly the type of environment that Bitcoin has been operating in. Portfolio options coverage is close to 100%, which will allow them to generate more premium, but take less part in the upside. And then, of course, like you already know, net asset value has grown since inception. Now, number 2 on our list, the second highest yielding covered call ETF with no NAV decline is another Bitcoin covered call ETF. And this time it's going to be coming from the fund managers at NEO. We have BTCI. Now, this one has not existed for nearly as long as Maxi. We can see it started trading in October of 2024, so it's coming up on 1 year old, but during that time, the share price has grown by about 14.24%. But where this fund is dramatically different from Maxi is the dividend stability. Yes, there's still some fluctuation with those dividend payouts, but not nearly to the degree of Maxi. We can see the lowest dividend payout was in October of 2024, but that's not really fair because that's when the fund started trading. So other than that, we can see in May of 2025, the lowest was about $1.26 per share, and it looks like the highest was back in January of 2025, $1.57. So yes, definitely still some fluctuation, but not nearly to the degree of a lot of these other covered call ETFs and funds. This is something that the fund managers at NEOS have had a lot of success with. much more stable distributions when it comes to their covered call ETFs. So if we go ahead and jump over to the NEO's website and look at the fact sheet for BTCI, we can see they have 3 different goals. Number 1, high monthly income generation. BTCI aims to generate high monthly income through a data-driven call option strategy that harnesses Bitcoin's high levels of price volatility. It seeks to take part in some of the upside potential with Bitcoin as well, and then of course you get the professional options management. Now if we look at this fund in the database, we can see the expense ratio is nearly identical to Maxi, but they've generated a lot more in assets under management, currently sitting at about 376 million. They also use out-of-the-money call option strategy, which again is better in a bullish environment, and the portfolio options coverage, according to NEOS, is adjustable for this fund, but it's likely close to 100% most of the time. Now, it shouldn't be any surprise that the 2 highest yielding covered call ETFs are both Bitcoin ETFs. And it's due to 2 reasons. To start, the overall price of Bitcoin is up about 82-83% in the last year. So it's a lot easier for these covered call ETFs to generate more premium when the net asset value is growing at a high rate. It's been operating in a bullish environment. But on top of this is something I was talking about on Dividendology.com the other day. Bitcoin's volatility is nearly 5 times higher than the S&P 500. And again, we have to remember when it comes to covered call ETFs, more volatility typically means more premium, meaning higher dividend payouts. We can see Bitcoin is quite a bit more volatile than even assets like Tesla, Nvidia, and oil. So when you combine the large amount of volatility with a share price that's grown 82% in the last year, again, no surprise that the 2 highest yielding covered call ETFs with no NAV decline are both Bitcoin ETFs. The third ETF on our list is QYLG. This is a covered call ETF focused on the NASDAQ 100, and the fund managers are going to be Global X. And if we look at the fact sheet, we can see 3 reasons to consider high income potential. As you should already know, there's upside potential. This is interesting. They only write calls on 50% of the portfolio, so the strategy allows investors to capture half the upside potential of the underlying index. This is really important to understand about QYLG, and we'll touch on this here just a little bit more in a moment. But then also we have the monthly distributions. QYLG has made monthly distributions for 3 years running now. If we look at this fund on Seeking Alpha, we can see the yield for the trailing 12 months is very close to 25%. And if we zoom out, we can see when it started trading all the way back in 2020, yes, it's existed for a while. It was around, let's see, 27.52. Right now, it's trading about 28.29. Now, here's part of the problem with covered call ETFs that we can see here. It can take a long time to recover if it operates in a market pullback scenario. So, for example, the market saw a large sell-off in late 2021 and throughout 2022, and QYLG didn't recover until December of 2024, and then it saw a huge market decline. This is one of the huge risks with covered call ETFs, and some covered call ETFs never recover from market declines. It's why it's really important you actually understand the fund that you're looking at. Now, if we look at the dividend payouts from this fund, it's somewhat unique. We can see, yes, they're making those large monthly dividend payments, but there's been twice now where we've seen a massive dividend payment paid out at the end of the year in 2021, and this also happened at the end of 2024. Why was this the case? Well, these US covered call ETFs are regulated investment companies. It's called RICs. Now, this means they must distribute at least 90% of their taxable income and realized gains each year to avoid corporate taxation. So if the monthly payouts didn't make up for that 90%, then QYLG will make a catch-up distribution in December, one large distribution in December. Now, this is where things start to link together. If we go back over to the covered call ETF database, remember we said this fund has about 50% portfolio options coverage. So what this means is if the NASDAQ 100 has a strong year, QYLG has about 50% of its portfolio appreciating at a high rate. So this means that they'll see some realized gains when stocks are sold, rebalanced, or if the options close out. They'll have a lot of gains. And so as a result, QYLG will be forced to make these large distributions right at the end of the year. Also keep in mind that these large December payouts can oftentimes include capital gains distributions, which can be taxed differently than ordinary dividends. Something to keep in mind. Now, unlike these 2 other ETFs we've seen so far, the expense ratio is just 0.35, which is relatively low for a covered call ETF, but we can also see they use at-the-money calls. This is another way that this fund is different from a lot of covered call ETFs. And again, it's really important to note the difference. At-the-money ETFs typically have higher options premium collected since the option has a higher chance of being exercised versus out-of-the-money calls, which typically has lower option premium since the option is less likely to be exercised. Now, on the flip side of this means out-of-the-money has more upside potential and at-the-money has very limited upside potential. But what's interesting about QYLG is, again, they only use about 50% portfolio coverage, so since 50% of that portfolio is uncovered, they can still take some part of the upside. So this is definitely a unique fund. It's an interesting one to analyze and study. Fourth on the list is another Global X fund, XYLG. Now, this fund is extremely similar to the one we just saw, QYLG, but this one, instead of the NASDAQ 100, is focused on the S&P 500. So when we look at things like the fact sheet, we're going to see pretty much the exact same information, writing calls on 50% of the portfolio. We're going to see things like at-the-money options. And like QYLG, this fund has been around for a little while now. We can see when it started trading, it was at about, $25.14, now at about $28.13. But what does scare me is it hasn't been able to recover since this huge sell-off. Now, it is important to note why this happened. Again, if we jump over to the ticker data sheet, we can see they made a huge distribution at the end of 2024. And again, these distributions are paid out of the net asset value, which is the reason we saw this large decline right here. You have to understand that the net asset value, what we're looking at right here, and this distribution is completely correlated. They're linked together. But at the same time, they had to do this for tax optimization. You can see there's a lot of moving parts to these covered call ETFs. If you simply just pull up the chart and look at it, you wouldn't really get the full picture. Now, this ETF for the trailing 12 months has a yield of about 23.79%. But again, it's important to keep in mind that a large part of that is because of that massive distribution that they made in 2024. So we can see the similarities with QYLG and XYLG. The yield for both of them are very similar. The expense ratio is the same. They both use at-the-money calls, and they both use 50% portfolio options coverage. Number 5 on our list is IGLD, the FT Vest Gold Strategy Target Income ETF. That is a mouthful, and I'm not going to lie, the website is certainly a little bit outdated. But with that being said, it doesn't mean the fund is bad. We can see the goal is to seek to deliver participation in the price returns of the SPDR Gold Trust, which is the underlying ETF, while providing a consistent level of income. Now, we can see at inception, the fund was trading at around 1983, and right now it's at about 22.25. Now, like the two funds we just saw, we can see there was a huge drop in the net asset value right at the end of 2024. But again, just like these other funds, that's because they made a huge distribution at the end of that fiscal year. Now, with that being said, over the trailing 12 months, this fund has generated a yield of 17.28%. And despite their outdated website, we can see they've actually generated a decent amount of assets under management, currently sitting at about $210 million. And we can see this is an active fund. I did mean to mention, those Global X funds are actually passive funds, which is pretty unique for covered call ETFs. Now, the expense ratio on this one is a bit higher, currently sitting at 0.85. They use out-of-the-money calls, and the actual portfolio options coverage can vary, which that'll be the case at times if there is an active strategy in place. It gives the fund managers a little more flexibility. Next up, we have another Global X fund, DYLG, the Dow 30 Covered Call and Growth ETF. And again, it's very similar to these other Global X funds that we've seen. Writing calls on 50% of the portfolio, at the money options, same expense ratio, again, just a different underlying index. So when we look at this fund, we can see since inception, it's up slightly, and the yield for the trailing 12 months is about 16.51%. But again, a large portion of that is simply due to the fact they made a very large distribution at the end of 2024. So again, a Global X fund, essentially just a different underlying index. We can see assets under management is actually very low for this fund, but the expense ratio about 0.35, passive option strategy, at the money calls, and just 50% portfolio coverage, so they can take more part in the upside, which again will occasionally lead to those large distributions if the underlying has a very good year. And then finally, coming in at number 7, we have actually the youngest covered call ETF on this list, and that's going to be QUSA, the VistaShares Target 15 USA Quality Income ETF. And the target distribution rate is 15%. Now, there's 3 goals. Number 1, like all these ETF, it's high monthly income generation. Number 2, core equity exposure. QUSA provides exposure to a portfolio of US equity securities with strong quality characteristics. That's the key. They're looking for quality holdings. And then, of course, you get professional options management. So this is an actively managed fund, and so they pick the stocks that they want to write options on, and the goal, they say, is to look for quality stocks. So for example, we can see there's stocks like Microsoft, stocks like Visa, stocks like Costco in their holdings. Now, you could argue whether or not this fund actually deserves a spot on the list because it's only been publicly trading since the beginning of May. And so because of that, whether or not they've actually grown net asset value since inception is literally changing on a day-to-day basis. But so far, if we look at the dividend history for this fund, they have been achieving their goal of targeting that 15% distribution rate on an annual basis. So we can see assets under management about 16.4 million. The expense ratio is about 0.95, so one of the higher expense ratios on this list. Active options management, out-of-the-money calls, and 100% portfolio options coverage. Now, this fund is actually so young that I emailed the fund manager just to make sure I had accurate information on some of these variables, and he did confirm it for me. But there you go, those are the 7 highest yielding covered call ETFs with no net asset value decay. Now, I will warn you, just because these funds have been successful in the past, because they've grown net asset value in the past and have generated large premiums in the past, doesn't mean that will be the case in the future. It's so important to understand the different strategies of these funds, the options moneyness, the portfolio options coverage, to understand whether it's a single stock or an index underlying holding. But if you can understand all those different variables, you're going to get a much better idea as to which of these covered call ETFs could actually best fit your needs, if any. Again, if you want to get access to this covered call ETF database completely for free, you can download it at the link in the description. And if you want to get access to my other databases on alternative high yield assets such as business development companies, REITs, and more to come soon, then be sure to join around 78,000 other people who are already subscribed to Dividendology.com. There's a link in the description, and I'll go ahead and throw up a QR code in case you're watching on your TV or some other device. But with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.